Welcome to the Explainer. I am absolutely pumped for this one, because today we're putting O'Reilly Automotive through the ultimate fundamental analysis test. We like to call it the Valuation Gauntlet. We're going to strip away all the market noise and use some of the most legendary investing frameworks in the world to see what this stock is truly worth. And the best part? You can use these exact same tools to evaluate your own portfolio. So let's get right into it. Here's our roadmap for today. We'll systematically evaluate the stock using the frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, and then top it all off with rigorous quantitative models like a discounted cash flow analysis. First up, a quick company snapshot of O'Reilly Automotive. O'Reilly, trading under the ticker symbol ORLY, is an absolute titan in the auto parts retail space. They serve everyone from professional mechanics to everyday DIYers. But before we crunch any numbers, we need a baseline. As of the data in our sources, the stock is trading at $85.75 a share. That is our anchor. Everything we do from here is just trying to figure out if that $85.75 is a bargain, a fair price, or if it's way overpriced. And wow, just look at the sheer financial firepower this company commands. Based on their fiscal 2026 guidance, they're looking at up to $19 billion in revenue and earnings per share between $3.15 and $3.25. They are a literal cash machine, guiding for roughly $1.8 to $2.1 billion in free cash flow. Oh, and the board just bumped up their share buyback authorization by another $2 billion, bringing the total cap to a staggering $31.75 billion. That is a massive commitment to returning capital to shareholders. All right, let's move into our first real test, the Buffett lens, focusing on quality and economic moats. So when we try to channel Warren Buffett, what are we looking for? We want wonderful companies with wide economic moats, rock-solid earnings, and management that actually cares about shareholders. And you know what? O'Reilly checks almost every single box here. Their moat is this incredibly dense distribution network of 399 hub stores, plus an AI-driven supply chain that makes parts delivery ridiculously fast. Earnings? Try 33 straight years of comparable store sales growth. 33 years! Debt sits at about $6.02 billion, which S&P gives a solid BBB rating, totally manageable given their cash flow. And as we just saw, management is super pro-shareholder with those massive buybacks. But this right here, this single metric tells you exactly why Buffett would be drooling over this business. A return on invested capital above 45%. That is just phenomenal capital efficiency. Basically, for every dollar they plug back into their store network, they're generating massive returns. It easily clears Buffett's high bar for business quality. But wait, Buffett is famous for demanding a margin of safety, right? So if we look at their owner earnings, which happens to line up really nicely with their free cash flow guidance of $1.8 to $2.1 billion, and we apply a standard 20% margin of safety to our valuation models, well, Buffett probably wouldn't be buying at today's price. He'd likely be waiting for a pullback, trying to grab shares somewhere in the mid-$70 range to really protect his downside. Okay, let's switch gears. Section 3, the Lynch lens, finding growth at a fair price. If you're using Peter Lynch's playbook, O'Reilly falls perfectly into the stalwart category. Look, with almost $19 billion in revenue, it's not some nimble little fast grower anymore. But it still pumps out incredibly steady mid-single-digit sales growth, and it gives you really solid downside protection when the economy gets bumpy. Stalwarts like this are exactly what Lynch built his portfolios on. Now, the holy grail metric for Lynch is the PEG ratio. That's price to earnings divided by growth. If we take O'Reilly's implied PE ratio, which sits at about 26.7 right now, and divide it by their very impressive 16% Q1 EPS growth, we get a PEG ratio of roughly 1.67. For Lynch, a PEG of exactly 1 is fair value, and anything under 1 is a bargain. So, at 1.67, it's definitely a bit pricey. That said, their strong BBB-rated balance sheet certainly works in their favor here. So what is the final Lynch verdict? Well, our sources don't give us specific data on insider buying or institutional ownership levels for O'Reilly, so assuming industry average is there, that slightly elevated PEG ratio means this is a solid Lynch hold. It's a fantastic stalwart, no doubt about it, but it's just not trading at that screaming bargain level that Lynch would jump at. Moving right along to Section 4, the Graham lens, deep value and a strict margin of safety. Let's put O'Reilly through Benjamin Graham's defensive investor checklist. Adequate size? Yep, pass. Strong financial condition? Pass. Earning stability? Definitely pass. But here is where things fall apart. Dividend record? Fail. O'Reilly doesn't pay a dividend at all, they just do buybacks. Moderate PE and price-to-book ratios? Big fail. Graham practically demanded PE ratios under 15, and O'Reilly is hovering all the way up near 27. Graham also relied on a very specific formula to calculate intrinsic value. It's the square root of 22.5 times earnings per share times book value per share. Now, to run this, we absolutely have to know the book value per share. And here is a fascinating little quirk of modern finance. Because O'Reilly has done such massive, aggressive share buybacks, again, over $31 billion authorized, they've effectively bought back so much of their own stock that it completely wipes out their accounting book value. It pushes it into negative or negligible territory. So applying Graham's strict formula literally breaks the math here. Combine that with the high valuation multiples and no dividend, and a traditional strict Graham value investor simply wouldn't touch this stock today. All right, let's step away from the gurus for a minute. Section 5, Quantitative Models, DCFs, and Alternative Metrics. To build our base case discounted cash flow model, we're going straight to the source and using management's own guidance. We're starting with the midpoint of their projected free cash flow, which is $1.95 billion. For the growth rate, we're going to assume a pretty modest 5% over the next 5 years, which matches up really nicely with their own targets for comparable store sales growth. But you have to realize how incredibly sensitive fair value is to these assumptions. We've plotted a weighted average cost of capital, or WACC, of 7 to 9% against a terminal growth rate of 1 to 3%. If we assume an 8% WACC, which is pretty standard for a stable BBB retailer, and a 2% terminal growth rate, our base case fair value lands right around $80 per share. So, based purely on projected cash flows, that $85.75 current price tag looks slightly overvalued. And when we peek at some alternative models, they totally confirm this tight valuation. The sources highlight that O'Reilly trades at a 19 times EV to EBITDA multiple. That is a huge premium when you consider competitors like Napa trade somewhere between 7 and 13 times. Plus, if we run a reverse DCF, which basically asks, hey, what kind of growth is the market already assuming here? It shows us the market expects perpetual mid-single-digit growth just to justify today's $85.75 price. Essentially, it is priced for perfection. Okay, we've run the gauntlet, Section 6, Synthesis, and our final verdict. Let's look at the master scorecard. The Buffett lens points to a buy closer to $75 if you want a real margin of safety. Lynch tells us it's a solid hold because of that 1.67 PEG ratio. Graham is a complete pass because it fails his strict defensive rules. And our own DCS gives us a fair value right around $80. Taking all this together, pretty much all of our models are screaming that the current price of $85.75 is fully valued, maybe even a little stretched. You'll really have to weigh the sheer quality of this business against the price tag. The strengths are unbelievable. An unstoppable 33-year streak of growth, an ROIC blowing past 45%, and a cutting-edge AI-driven supply chain. But the risks are real, too. You've got the long-term threat of electric vehicles, which just need fewer traditional parts, near-term macro pressure on the everyday DIY consumer, and let's not forget that $6 billion in debt. Which brings us to the final verdict. O'Reilly Automotive is a phenomenal, incredibly high-quality company, but after running it through our gauntlet, it earns a hold rating at $85.75. If we blend all our frameworks together, we get a target buy price of roughly $75. So I'll leave you with this provocative thought. Considering how absolutely flawless this company's execution is, will the market ever actually give us a correction severe enough to hit that perfect margin of safety? Or is paying a premium the only way you get to own a masterpiece? Something to think about. Thanks for tuning into this explainer and keep learning.